On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. Before you make any decisions, we recommend you contact an investment advisor. For more information about our services in that regard, or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope everyone is well. I want to talk about the market sell-off that we've seen recently and some of that volatility. There has been a very strong period across global share markets. We've seen a lot of markets around the world, particularly in the US, hit new highs, but more recently, volatility has returned. Now, economic activity is still holding up very well, but what's happened is we've seen concern over high share prices, especially in that booming AI space. We've seen that turn optimism into caution. And we even had that better than expected earnings release from tech heavyweight Nvidia, and it couldn't turn things around on the day after it came out. So the S&P 500 index in the US finished last week down almost 5% from its recent highs, while some of the higher octane parts of the market have fallen more heavily. The tech sector is down 10%, while Bitcoin has been hit much harder. It is more than 30% below October levels. Of the Magnificent Seven cohort of stocks, Meta, which is about 25% off its highs, has fared the worst, and Alphabet and Apple have actually held up very well and proved much more resilient. Now, those numbers will change. I'm recording this on Sunday afternoon because I've got to travel on Monday and Tuesday, so I've got to get this work done early. So by the time you listen to this, some of those returns figures will have moved around a little bit, but we are still in a volatile period. And these moves will be causing a lot of consternation amongst many investors, particularly those who have entered the fray in recent months. However, we need to understand and appreciate that it is far from unusual for markets to experience a sell-off like this, especially after such a great run. And in fact, and this is my key message that I want many of you to take on board, for new investors, rough markets like this can be your friend. We need to look forward to these periods rather than fear them, because I don't know about all of you, but I am not a big fan of buying investments at all-time highs. That goes for shares and things like that, but also the housing market. Should we be excited about having bought our first house or our new house in a booming market where everyone's optimistic? Of course not. You want to be buying when there's fear, when there's nervousness, when there's uncertainty, because that's when prices tend to be lower. So we've just got to change our mindset to investing to reflect that sort of approach. I think it really will do us a lot of favors in the future. I would rather put my hard-earned cash to work when prices are 5% down, 10% down, even 20% down. Now, for someone who's about to sell up their portfolio and retire, a period like this sort of volatility, this potential weakness, that can be awful. And if you've had that house deposit sitting in a high-growth KiwiSaver fund, in a portfolio of tech high flyers, or worse still, in crypto, you will be more than a little nervous right now. But the truth is, anyone in that situation should have invested much more conservatively anyway. Growth assets like shares or real estate, they are only appropriate for your long-term money. And if that's the case, and you have indeed got an investment time horizon of 5 years or more, just relax. In fact, if you've got more capital to invest, or you're still in the accumulation phase of your investment journey, maybe you're 25, 35, 45, even 55, and contributing to KiwiSaver, you should be rubbing your hands together and hoping for more volatility. You want those next few KiwiSaver contributions to pick up some assets at lower prices, right? I do. In the past 15 years, we've seen 9 occasions where the S&P 500 index in the US has fallen 10% or more. So they come pretty frequently, don't they? 9 times in 15 years. So not quite every year, but not far off. Now, two of those times, we saw things develop into bigger falls of more than 20%. One of those times was during the COVID recession, and the other one was in 2022 when interest rates had hit rock bottom and they were rising sharply from those near zero levels in the face of higher inflation. But right now, US recession indicators are not flashing red. Inflation is maybe a little higher than we would like, about 3% in the US, about the same here in New Zealand, but it's still well contained. And while the timing is debatable, and I'm talking about the US more specifically here, interest rates are likely to go lower rather than higher. Now, those other 7 examples saw an average decline of about 15% from top to bottom. And they were driven by a range of things, everything from nervousness about a Chinese economic slowdown to Trump's tariffs and what they might mean for the economy and for markets. That was earlier this year. We can never tell what it's going to be that will cause markets to sell off. And it's often something that you don't predict or see coming. As far as this period of volatility goes, no one knows where things will move tomorrow or next week or next month. The S&P 500 could easily sell off a little bit more, could easily end up 10% off its highs. It's about 4% off its highs right now. Or it could rebound and recover tomorrow and hit new highs before Christmas. Your guess is as good as mine. But a point I want to make is that even if you did see a 10% sell-off from the highs, that would simply take us back to where we were at the beginning of July. So, look, it's not a complete disaster. No need to panic. Just stay calm. If those ups and downs continue, just keep in touch with your investment advisor or your KiwiSaver manager or whoever you work with to help manage your wealth. They will have navigated periods like this before, probably many times if they've been around for a little while. They will help you stay disciplined, they will help you keep your cool, and most importantly, they will make sure that you remain on track and that you're investing in line with your objectives. Now, those 9 sell-offs that I talked about since 2010, they have lasted an average of 3 months, which isn't very long. Sometimes longer, sometimes much shorter, but an average of 3 months. So remember, these periods do tend to blow over pretty quickly. They can be really scary when we're in the thick of them, but we tend to look back with hindsight and they aren't that big a deal. So if we do see a bigger correction in the months ahead, don't squander it, because before you know it, you might be looking back and thinking, geez, I wish I had done some more buying. All right, that's all for today, team. Thanks for listening, and we'll talk again soon.
For more insights, visit craigsip.com.